ESG, environmental, social, and governance investing, is getting a lot of talk these days, and lately it's getting some action as well, with the engine number one dissident shareholder group upending the Exxon Mobil board, and this week launching an ETF to take the campaign into other boardrooms as well. Chris Ailman of CalSTRS and Barbara Ann Bernard of Wincrest Capital are still with us. So, Chris, I want to start with you because you had a little something to do with this, with engine number one. Give us your sense of why you backed these dissidents and what effect you think it's going to have on Exxon.
David, we have been having engagement and dialogue with the integrated oil companies for several years now because we're really concerned about the future and it's going to be lower carbon, and these companies have to change and adjust. Exxon Mobil has just been recalcitrant. They have just ignored shareholders for several years. New York Common made a run at them, New York City, CalPERS, and they just rebuffed everybody. We felt that it's time to change at the top. When Engine One approached us and said they're going to propose an alternative slate for a board, we said we would get behind them. So when they announced in December, we came out the same day endorsing their slate, and that was intentional. And we worked behind that, supporting their effort. We weren't proxy solicitors. What we were doing was really just calling our huge network of institutional investors in all the groups and raising this and making them aware. And I think in the end, it was Exxon's own actions of adding board members, suddenly talking about carbon sequestration. They really changed their tune because they realized that shareholders were unhappy and were frustrated. And look at that stock chart. It really turned around. Now, all the integrated oils have come up, but look at Exxon relative to the others. And I think the fact that we were finally engaging with them and making some traction with management was waking the shareholders up, and they cared. And it was a huge move. So I think the announcement that we saw that they elected three board members onto the Exxon Mobil board is dramatic. And it really is going to signal a change from the top. Now their hard work begins. I don't want Exxon Mobil to become a Kodak, a blockbuster video store, or I'll go back in my time, a warehouse record store. We want to see Exxon Mobil actually exist 20 and 30 years from now, but they've got to change and adapt to be able to do that. They can't just stick their head in oil and gas only. And I know we've received criticism of that because that's their main calling, but they can adapt and they can adjust and become an energy company. And we're going to need hydrocarbons into the future, but we're not going to necessarily need to burn them. We're going to use them for lubricants and other things. So they've got a product mix. They've got a very solid company. They have good research. I'm optimistic with a new fresh board at the top and a change of tone at the top that this company can adjust and adapt into the future and survive, as we're seeing with all the major oils having to do, to recognize the future is lower and lower carbon emissions.
Barbara, and what about it? You're an expert in ESG investing and something, I think, of an enthusiast for it. Is it enough to adapt, or do we need to start taking the carbon out of the atmosphere, just not putting quite as much into it?
So, Chris, what I think you did was great. And if you can change their capital allocations decisions and save your investment, good on you. That is phenomenal. But what happened this week with the launch of another index tracking ETF, I don't think is the answer. There is no energy transition without an investor transition. So ESG 1.0 was buy the index and slightly overweight tech and underweight oil and gas and charge a premium for it. So we've gone from passive ESG to what I would now call passive aggressive ESG with Engine 1.0. And while it's good, and I hope, I wish them well, I think ESG 2.0 is not engine number one. ESG 2.0 is the little engine that could. And the little engine that could invest in the renewables and the copper and nickel and lithium mines that are mining in sustainable ways that are going to drive this transition. It's investing in the ESG leaders who are decarbonizing and are disrupting their models, because we do need, as Chris says, their services, but we need them with less carbon. So I don't think ESG 2.0 is about the index at all. I think it's about decarbonization, and it takes investment, not divestment. If you listen to Morgan Stanley, they wrote a report. They said we need 50 trillion to solve climate change. 103 trillion has been committed per the UN Principle of Responsible Investing. 2 times what's needed. So the problem isn't the money. The problem is it's going to all the wrong places. And so, Chris, I'm so excited that institutional capital is finally starting to work together. But now that you've got directors and now that you've got disclosure,
Right.
I think the next step is using your heft to advocate for policy change. Because if you enact a tax on carbon, you're going to get the same result without having to jump up and down in the boardroom. When you change the incentive, you change behaviors.
Chris, what do you say?
No, Barbara Ann, I agree with you. I was just going to say that, I think that the key is we have been making very large sustainable and long-term investments. We've been allocating more money to more sustainable companies. What we're trying to do is to recognize that everybody, whether it's an index, and there's just still a lot of money in index funds, but that all the companies, if they want to survive in the future, have to change and adapt. They can't just stay stuck in the current methodology. And you're right, David, we've got to take carbon out of the atmosphere. We've got to change the way we get energy, the way we transport, and especially the way we do agriculture. And then ultimately certain things like, as we've talked, concrete, steel manufacturers have to find new, better ways, less carbon intensive ways to do that. So for us, it's a holistic investment, including our index, not excluding it, but including it. And it is active management. I've said for a while that I think of ESG, climate change is the one active decision people have to make, and they have to make it now. Right. Because in the next 10 to 20 years, the world is going to radically change, and you can't just sit on an index and wait. You need to invest and make active decisions ahead of that to capture those opportunities. So we think that the changes is inevitable. We've got a big sustainable portfolio that we already invest over $8 billion in new sustainable solutions, and we're going to increase that over time.
So this is a truly great discussion on ESG. I want both of you to come back and have it at greater lengths because we have more to talk about, but I want to throw you a curveball right now. I'll go to you, Barbara Ann, because we now know that GameStop, that meme stock, has been added to the Russell 1000. That's just happened at the end of the week. So what do you make of these meme stocks? Are they changing the entire index investing scene?
Oh, goodness. I love to short, but I don't get involved in those. It's not a good investment, right? And so it's heartbreaking to see companies like that get in an index. We all know it's not worth what it is today, what it's trading for today. So yeah, I'm not for passive investing.
So Chris, let me go back to you on this. We all know Gresham's law, right? Is this a version of Gresham's law with these meme stocks?
I think so. And where Barbara Ann doesn't like passive, we are passive. I have served on the Russell Index Committee. I serve on the MSCI Advisory Board. And I can tell you when it comes to construction methodology, we make some basic assumptions that the markets are somewhat rational in their pricing. And that's what's very frustrating today being Reconstitution Day for the Russell 3000, 1000, 2000. They got stuck. And I would agree, this phenomenon, this trading phenomenon has happened before. It happened in the 90s with day traders. This is more extreme. The fact that commissions are at zero and people are bidding up these stocks to silly levels, frankly, and unrealistic levels from a Wall Street valuation perspective. It's frustrating, and I haven't minded them. They're sort of a sideshow, but now it's actually impacted the index. For that to pop up all the way into the Russell 1000 index is frustrating, but it's probably a way that people can actually change the weighting and make some money on the index then this year.